Earnings season is still underway, and professional options traders have some powerful tools available to them to leverage the unique properties of options right before companies release their quarterly earning reports. Hi, I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan. And experienced proprietary traders utilize techniques that can generate incredible returns very quickly. In this video, we're going to give you an example of a surprisingly easy to learn option strategy that earned in one day a pretty remarkable return. So stick around. I think you're going to find this interesting. Hi, I'm Seth Freuberg. I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so as many day and swing traders know, Tesla released its Q4 earnings report after the market closed on Wednesday, January 27th. And as you can see, a few minutes before the market closed on that day, Tesla was trading around 865, having rallied dramatically off of its COVID-19 crash lows back in March of last year. Now, we're about to show you a one-day trade that's popular for professional options traders who like to trade options on companies that are approaching earnings. But before we do that, we're going to make sure that everyone watching this video has a firm grasp on how options derived from stocks known as equity options actually work. And I realize that most of you probably know something about how options work. So just for a quick review, and this is going to be fast, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of the option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of his stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below the market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. On the other hand, at expiration, if you sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. And it's important to also keep in mind that as call options approach expiration, they lose a lot of their value if the stock is trading well below their strike price. And conversely, for put options, they lose a lot of value if the stock is trading well above their strike prices, because in both cases, the chances of them having any value on expiration day is getting very, very small. So traders are not willing to pay much for that protection. Okay, so now with that as background, let's take a look at this Tesla option strategy that could have been executed before earnings on January 27th. Now, the strategy that we're going to be studying today is called an iron condor, and we will drill down now and explain why we're doing what we're doing. So let's say that on 3:30 in the afternoon on the day that earnings would be released after the market closes, we were going to go to the options chain that expires 2 days later on January 29th. We'll sell 15 of the 950 calls priced at 1372, which are about 85 points above where Tesla is trading. And we'll also buy 15 of the 960 calls for 1188, 10 points further away from Tesla's price for protection. Simultaneously, you could sell 15 of the 790 puts, which are trading for 1159, and buy 15 of the 780 puts, which are trading for 955, again, for protection. Now, this formation, a short call above a stock's price and a long call with a higher strike price, combined with a short put below the stock's price and a long put farther below the stock's price, when you execute all four of these trades at once, which, by the way, your broker will allow you to do through what is known as a complex order ticket, when you combine these four trades at once, that formation is known as an iron condor. Now, before we get into why we would structure an iron condor in this way right before Tesla releases its earnings, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. In that webinar, we're going to be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% of probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open a free registration page in a new window. So don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now back to the Iron Condor earnings play on Tesla. And the first question that you might be asking is, why is it that we picked the put and call strikes that we did so far from where the stock is trading at what is statistically actually a 1 standard deviation move around the price of the current market price of Tesla? And to drill down into that, we need to think about what happens when a company's earnings reports are released. And as I'm sure most of you are aware, an earnings release is a key event for a stock every quarter. And frequently, the earnings release will provoke a large move in the stock's price. And so if you think about it, the options market makers who set the prices for options have to build that big potential price move into the call and the put options that have strike prices close to the price of the stock, or they could risk losing a lot of money selling calls or puts around the time of the stock's earnings release. So to demonstrate this principle, let's take a look at the cash flow we received from entering into this iron condor. And as we mentioned earlier, we sold the 15,950 calls for $13.72. And remember, those represent 100 shares of Tesla. So you multiply that by 100, and we sold 15 of those. So the total received is $20,580. And remember, for protection, we bought 15 of those 960 calls for $11.88. And so you can see from the calculation, we had to pay out $17,820 for those. Now, on the put side, we sold the 790 puts below the market for $11.59, bringing in $17,385. But for protection, we turned around and paid out $14,325 for those 780 puts. And so if you crunch all the numbers together, we actually get a net of $5,820 of cash flow brought in from selling that iron condor, for which your broker incidentally would require capital of $9,180. Now, to understand how dramatically impending earnings affects options pricing, let's go back about a month to 2 days before the December 29th expiration. So again, we're 2 days away from these options expiring, but in this case, earnings will not be coming up the next day. And so let's construct an equivalent trade and see what happens. And as you can see, at that time, Tesla was trading at 663. And so if we were to construct an iron condor with the exact same parameters, the short call at about 85 points above the market and the short put about 75 points below the market, with long options 10 points away on both sides, let's see how that situation compares from a cash flow standpoint. And as you can see, it's a completely different ballgame. We won't go through each option because that'd be tedious for you, but you can see that the options are all valued below $1, whereas in the example of 2 days before Tesla's earnings, the ones we showed you before, all of the options were near or well above $10 in value. And so it's no wonder that the iron condor expiring in 2 days has virtually no premium in it at all. in this case, $115 when nothing special is happening over the next 2 days. But the credit ballooned to over $5,000 when earnings is coming up, as we just showed you. And that is because selling those call and put options is much more dangerous before earnings, as this example clearly illustrates. So now let's come back to that earnings trade on Tesla in late January, the one where we entered the afternoon before earnings are announced, and we received $5,800. And so if we move to the next afternoon, after earnings are announced, you can see that Tesla sold off down to 837, off $26 from its previous close before earnings were announced. But if you look at the pricing of the options that comprise the Iron Condor, you're going to see something really interesting. And that is that the options prices are all now below $1 in value, whereas the previous day they were all priced near or above $10 a piece. And the major reason for that is something that options traders call vol crush, which is what happens when the value of options nosedives right after a big event takes place when, and this is the important part, the unknown reaction of the market to the earnings release has now turned into a known. And therefore, the option sellers can relax and don't have to load so much price into their options, because the danger of selling those options has gone way down, because now the market knows Tesla's earnings and knows that the market has had a mildly negative reaction to them, bringing the stock price down just 2 to 3% the day after their earnings announcement. And so even though with that downward move, as you can see from the options chain, the calls are now over 100 points above Tesla's price, and the puts are more than 45 points below Tesla's puts, and the options are expiring in about 24 hours without a major event on the horizon, like earnings over the next 24 hours. That's already happened. And so it is no wonder that the options prices are now reflecting a very little risk that the market can actually reach those price levels, up or down, in the next 24 hours. And therefore, the pricing has largely come out of the options with just 1 day left. So at this point, let's look at what happens if we were to close the trade 24 hours after we opened it. And so to analyze the conclusion of the trade, we'll reiterate that we originally brought in $5,800 from selling the Iron Condor that afternoon before earnings were released, when the options prices were incredibly pumped up. And as you can see, the options prices are all much lower now. So selling the long protectives calls at 960, we would only receive $400 for those, while we paid over $17,000 for them originally. But notice how little we have to pay to buy back the short 950s, which we sold for over $20,000. And we only have to pay $465 to buy those back and close them. So as you can see, vol crush is an equal opportunity crusher. It crushes the prices of options that were long and options that were short. And you can see similar small amounts on both the long and short puts that we're also exiting, resulting in an overall profit for the trade of $5,415, which is a return of over 58% in a day. And so you can see why professional traders love earnings trades when they're set up correctly. So what I'd like you to take away from today's video is that when options are about to expire and there's no big event about to take place like the earnings release, then an options income trade like the Iron Condor is not exactly exciting from an income standpoint, as we showed you with the example from a month earlier. But right before earnings are released, the pump up in what options traders called implied volatility, that big increase in pricing that takes place as the market anticipates a big move in the stock right after earnings, that increase in options pricing creates unique and potentially very profitable opportunities for one very important reason. And that is that once the earnings report is in fact released, the volatility is returned back to normal levels for an options chain about to expire. And that return to normalcy is known as the vol crush, which results in our being able to close the short options we sold for next to nothing. And even though we make next to nothing on the protective long options we bought at trade entry, the overall cash outflow from closing the trade, as you can see, is a fraction of what we collected initially to initiate the trade, resulting in a truly profitable trade very, very quickly. Professional options traders are aware of the vol crush and how it sets up such profitable trading opportunities, and they take full advantage of this phenomenon when the time is right for stocks that they like to follow. Now, just to remind you, as I said earlier, If you enjoyed this video and learned something valuable from it, and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.